Hello, in today's video we're going to be taking a look at the Wednesday, October 8, 2025 trading session for the CBOE SPX index, trading SPX 0DTE options utilizing the day trading GPS SPX Daily Key Levels indicator, specifically the newest version of the indicator V2.0, which was released 2 weeks ago. Okay, so some of you may already be familiar with how this indicator works, but for those who are not familiar with it, I'll run through how it works quickly. So at 9:30 a.m. Eastern New York time, when the SPX CBOE index opens, you will get the daily key levels that are updated on your chart. The most important level of the day is going to be your SPX bull bear key price level. So it's abbreviated KPL, and for today's session it was 67.2296. The indicator also gives you 6 main levels above the bull bear KPL, R1 through R6, and 6 main levels below the bull bear KPL, S1 through S6. As you can see here, we've zoomed in on R3 down to S2, which S2 also coincides with this other level, which we'll explain what that level is in a second. This indicator can also go up to 10 levels above R1 through R10 and 10 levels below S1 through S10 for days that we have extreme volatility, which we have not had in a while, but we did experience during the COVID pandemic and at other times when we've had major news. So on most days you're going to focus primarily on R3 through S3 because those are the levels that are most in play, say 80-85% of the sessions. So it is recommended when you're using this indicator to at first zoom in on R3 down to S3, or at least R3 down to wherever the YDL level is. Okay, let me explain these other levels. These other levels here, PMH is the SPX pre-market high, PML is the SPX pre-market low, YDH is the SPX previous day RTH session high, YDL is the SPX previous day RTH session low, and YDC is the previous day RTH session close. These are also important levels to keep a watch out on, as I'll get to in a few minutes. Okay, so the levels above the bull bear KPL, the main levels above and the midpoint levels above, are your take profit levels for trades that are derived from and initiated from the bull bear key price level. So that would be for bullish trades that are derived from and triggered from this bull bear key price level. Your main levels above are going to be your take profit levels on bullish trades. On bearish trades that are triggered from, derived from the SPX bull bear key price level, on bearish trades derived from that level, your main levels below are going to be your take profit levels for bearish trades. About 90 to 95% of the time during the opening first part of the session, your trades are, if you take trades, they're primarily going to be derived and triggered from the bull bear key price level. Later on in the session, however, you will have trade opportunities that can be derived from the other levels, and in the last 25 minutes of this video we will go into detail on how to trade both bullish and bearish trades off of the other main R levels above and S levels below, how to take those trades, and also we'll be going over in that section of the video the two different types of trade entries, your standard trade entries and how to recognize them, as well as the more conservative trade entries, which will require more confirmation, and we will go over how to recognize those. Okay, so we have here, this is the 9:30 a.m. candle for today's session. This is marked off here with this timestamp. So this is the opening candle of this session. As you can see, it opened above, slightly above the bull bear key price level, continued up, challenged the pre-market high, and then closed below the pre-market high, but still closed above the bull bear key price level. So if you wanted to take a trade off of this 9:30 opening candle, this is your signal for a bullish trade that's triggered from the bull bear key price level. We're on a 2-minute chart. This indicator works on chart time frames from 1 minute up to 30 minutes. If you have your chart set to a time frame higher than 30 minutes, there'll be a message that will come on your chart telling you to put your chart back to a time frame between 1 minute and 30 minutes. The recommended time frame for intraday trading on this indicator is the 2-minute time frame. However, other people prefer other time frames such as 1 minute, 3 minute, 5 minute, 10 minute. You can also use those time frames as well. However, as you'll see if you've watched some of our other videos, that the time frame that we use consistently is the 2-minute time frame, so that is the recommended ideal time frame to use it on. Okay, so this is a bullish entry here derived from this level. So how you determine what SPX call option to use on this bullish trade is a 0DTE call option. You can also, if you prefer 1DTE, you can also use 1DTE. I would not use anything further out than 1DTE though. But as you can see in all of our videos, including today's video, we use 0DTE because in our mind it provides the best reward for the moves. So a 1DTE option is going to be more expensive. If you want to look at how the 1DTE options played out, you can just go and look at your data boxes for the different levels that were hit here, as well as what the price would have been to get into the trade on your own time. As you can see here, we have the data boxes for the 2-minute time frames for the option that we picked here, which is the 67.25 call option. Now the reason the 67.25 call option is picked is because that is the closest strike in the SPX option chain to today's bull bear key price level. So you are picking a strike that is closest to the level that the trade is derived from. In this case, that's the bull bear KPL. It's 67.2296. And for those of you who may not be familiar with SPX options, they trade in $5 increment strikes. So for example, 67.15, 67.20, 67.25, 67.30, etc. So 67.2250 would be in between the 67.20 and 67.25 strike. And if the bull bear key price level happened to be 67.2250, then you could choose either one of those strikes. However, if it is over the midpoint of 67.2250, then you want to go with the strike that is closest to it, which in this case would be the 67.25 strike. For those that wish to use out of the money strikes because they cost less money, keep in mind that out of the money strikes need to move further in order to provide profit than the at the money strikes do. They are less expensive to start with, so you have less money total at risk, but they will need to make a bigger move. How you would determine which out of the money strikes to use is you take the level that the trade is derived from, in this case the bull bear KPL, and in the case of a bullish trade, if you're looking for out of the money call strikes other than the at the money, which is the standard recommended one to use, then there are two options. You look a half level above and a full level above, and you get and your option would be the closest strike to what those levels are. So in this case, this mid level above the bull bear KPL is 67.2867. So the closest strike to that is 67.30. And then the furthest out of the money you would want to go is one level away, which is the R1, 67.3438. So the 67.35 strike would be what you would pick for the furthest out of the money one to consider. The standard play, though, is just to do the at the money strike, which in this case 67.25 call, the 0DTE 67.25 call option. The entry price on the candle close of this 9:30 candle that closes at 9:32 a.m. since we're on a 2-minute chart, it is $11.80. For those of you who may not be familiar with how options work, basically you take the price of the option that you're paying, you multiply that times 100, and that is how much money you're laying out for one option. So in this case, if you were just buying one 67.25 0DTE call option at $11.80, then the cost for that one option would be $1,180. If, for example, you were buying 5 of them, then you would simply multiply 5 times 1,180, and that is $5,900. Okay, what about stop losses? The stop loss would be the same whether you pick the at the money strike or the or one of the two out of the money strikes. The stop losses are going to be the same no matter which strike that you pick out of those. How you determine the stop loss on a bullish trade is the standard stop loss in a bullish trade is going to be the first midpoint below the level that the trade is triggered and derived from. So in this case, since it's the bull bear KPL, we simply look for this stop loss. The standard stop loss on our bullish trade is going to be the first midpoint below the level the trade was triggered derived from. So that's this mid BBKPLS1 67.1725. It is recommended to use the standard stop loss. However, there are a lot of people, because of the risk profile, that wish to use tighter stop losses. So if you are inclined to use a tighter stop loss instead of the standard, then you simply pick the QL level below. On a bullish trade, the QL level below the level you're trading from. In this case, that is QL below BBKPL 67.2011. So as you can see here, if you did pick the tight SL, you were stopped out on this trade here, and then you could have re-entered here or here after getting full confirmation here after being stopped out after this closeout. So generally, if you are stopped out on the first trade, you want to be more cautious on the second trade if you are going to continue trading for the rest of the session. However, as you can see here, we have used the standard stop loss. We were not stopped out on that, and that is one thing for you to be cognizant of, that you are going to get stopped out more times on tight stop losses. So you just need to keep that in mind, that on tight stop losses you will have less money at risk. However, they are more prone to getting stopped out. But if you do want to use tight stop losses, the tight stop losses can be enabled in the user control panel, and the on bullish trades it is the QL below the level. On bearish trades, if this trade was in reverse, we were looking at a bearish trade, the tight stop loss would be the QL above the level you're trading. Whereas on a bearish trade, the standard stop loss is the first midpoint level above the level you're trading. So back to today's trade, it was a bullish trade derived from this level. Standard stop loss, first midpoint below. That stop loss was not breached. And here at 10 a.m. we have the candle hitting the R1 level for today. And for you scalpers out there, if you're using this indicator for scalping only, then a one level move is where you would 100% close out all of your option contracts. So if you're trading one, you would close. If you're only scalping, you close out whether you're trading 1 or 10. You would close out if you're only scalping after a one level move. So what do I mean by one level move? Well, you take the trade your level that your trade is derived from, and you look up what is the first main level. That is the R1 level. So that is one level, whereas this midpoint level is a half level. So here to here is one level. That's a one level move. This level here above the one level is the 1.5 level. This is 2 levels. This is 2.5 levels. This is 3 levels. Okay, so that's for scalping. If you're doing a regular trade, the ideal closeout level or adjustment level is going to be a 2-level move. However, the minimum point at which, using this indicator, that you can consider taking either a 100% closeout in full, considering a regular trade, not a scalp, would be a 1.5 level move. So at 10:10, the candle hit the 1.5 levels here at the mid R1, R2 on this 10:10 candle here. The candle preceding it before it, you may not be able to tell on this video, but that did not quite touch. It came up just slightly short of the midpoint level. So on the next candle here, it does actually touch and close through it. The price on the close of this 10:10 candle for the 67.25 option is $21.43 on the close of this candle. So the profit per call option now on this hit is $963, whereas if you were just scalping for the one level move here at the 10 a.m. candle, $16.73, your profit is $493 per call option. Okay, so here at 11:10, SPX hits the R2 level. So this would be your ideal 2-level move for 100% closeout or adjustment. The 67.25 call option is now 23.40 on this candle close. As you can see, the close of the candle, it just closed just slightly above it. So it touched and then closed slightly above it. So now this option is 23.40 on the close of this candle, and the profit is now $1,160 per call option. Going back to the YDH, PMH, PML, YDC, and YDL levels, where these levels come into play is any one of these levels that is over the 1.5 level move would also be potential adjustment levels or closeout levels for you. So, for example, if this on this bullish trade here, this would also be, in addition to this midpoint here, this is yesterday's daily high. This is another point at which, if you were still in this trade because you did an adjustment instead of closing out, which I'll get to in a second on how that works, if you just made adjustments to your trades, adjustments meaning you adjusted your stop loss or you were scaling out, which I'll also get to in a second, then and you were still in this trade either with runners or with your full lots, then YDH, if it's above the 1.5 level minimum move for a regular trade, that is considered another place at which you can either close out or make a further adjustment. The same thing in reverse. Let's say yesterday's daily low, let's say this was a instead of this being a bullish entry, this was a bearish entry instead, and the candle opened below and closed below. Then, since this YDL level happens to be in confluence as well with this S2 level, but the YDL level would be over the 1.5 level move. So I don't have the midpoint turned on between these two, but the midpoint here would be your 1.5 level move. So that's why the YDL is also in consideration. So even if the YDL was down here, or the YDL was somewhere between the midpoint and S2, then anything over on the bearish trade below the YDL would be, or any one of these levels that is below the 1.5 level point would also be levels that you can consider either closing out or making adjustments, as long as they are beyond the 1.5 level move point. And the same thing up here. Whatever one of these levels here is above the 1.5 level point, which is the minimum, then you should also consider those for points at which to either close out 100% or make further adjustments. Okay, so what do I mean by adjustments? So either closing out 100% or adjustments at the 1.5 level move. So what adjustments means is that if you're just trading one contract and you don't want to close it out, or you're trading multiple contracts and don't want to close any of them out, or if you're trading multiple contracts and want to close out 70 to 90% of them and then make an adjustment and leave runners. Okay, so for example, if you were just trading one contract and you did not want to close it out on a regular, you're not scalping and you're just making a regular trade and you don't want to close out here, then at this 1.5 level point move, this 1.5 level move here, which is the minimum at which you would consider this, if you're not closing out 100% and you simply want to make an adjustment, then at that point you adjust your stop loss to break even. So we paid $11.80, so we would adjust our stop loss now from whatever the level down here, and doing it by level to now we're adjusting it to where now our stop loss is at least $11.80, which is break even, or we are adding a profit buffer to that adjustment of somewhere between 10% to 15%. So let's just say if we round this off to 12, just for simplicity of math's sake for this video, 10% on 12 is $1.20, so you would make it $13.20. 15% of 12 is $1.80, so you would add $1.80. So for example, let me just get the calculator out here so we can have it exact. So 1180 times 10% is $1.18. So if you add $1.18 to 1180, that is $12.98. So you could round it up to $13. So if you were adjusting it just 10%, then you could make the stop with a buffer at $13. That way, if price retraces because you didn't sell, remember that this is if you're just doing an adjustment, you didn't close out 100%, or if you're trading multiple contracts, you didn't close out 70 to 90% and leave runners, you were just making an adjustment. That way, if price happens to retrace, then and it hits $13 on this option, then at least you're out with still having a profit. If you do a 15% adjustment instead, which would be the max, so $11.80 minus 0.15 is 177 plus 1180, so that's 1357. You could round it up to 1360. So if you did 15% buffer, then it would be adjusting it to 1360. You do not want to adjust it really further than that on this first adjustment, because if you make it too close, let's say that it was $21.43 and you wanted to make it $19 or $20, Well, that's just too close of an adjustment. You're probably for sure going to get stopped out. So if that's the case, if you're inclined to make it that tight, then you just might as well go ahead and instead just close out the contracts for the 2143. And that would be the same thing up here. If you're waiting to hit the 2-level move to make the adjustment, then that's where you would make the adjustment there, and you would go through the same process of the adjustment. And then as price continues to move forward in your favor, then you would add more of a profit buffer onto your stop loss as price continues to move on to your favor from level to level to level, adding more of a profit buffer on each level that it hits. If you're trading multiple contracts, everyone's different. You know, some people just like trading one contract in and out, one contract, that's it. Some people like trading 3, 4, 5 contracts. Some people trade 10 lots, 10 contracts at a time. Some people trade 20. Some people trade 100. So everyone's different. Everyone has a different account size, and everyone's process is a little different. So for those of you that are trading, say 4 or 5 or more options, then, for example, if you're trading 4 options, I mentioned the 70 to 90%, selling those and leaving runners. So at the 1.5 level move or the 2 level move, then you would sell 70 to 90% of your multiple contracts that you started with, and then you would make an adjustment on the remaining contracts that are runners. So for example, if you had 5 contracts, here you would sell 4, or here you would sell 4, and that would be 80%. If you had 4 contracts and you sold 3 of them, that would be 75%. And as far as the adjustment on the runners, it would just the same stop loss, break even, or add 10 to 15% on the runners. And then what you're looking for, as at some point, as it keeps moving in your favor, at some point you need to have in mind where your end game is going to be as far as closing out the rest of your runners. So whether you want price just to make that decision for you as you keep adjusting your stop loss and adding more and more profit buffer, and eventually when price eventually retraces, it'll just take it out, or you can just simply, have another level in mind, such as this YDH level in today's session, or the mid R2, R3 level, or the R3 level. Okay, so continuing on here, we pointed this out. Here at the R2 level, we have a profit of $1,160 per call option. Okay, and then the next hit is the YDH level. As you can see, it became very close to that level here, came very close here, came very close here, finally hits it here, wicks through it just slightly, and then closes slightly below it. This is the 12/18 candle. So the 67.25 call option is now $30.54 on this close after hitting it. The high was $31.20. That's on the high of this wick here. But on the close, $30.54. The profit is now $1,874 per call option. Okay, so if you are interested in purchasing this indicator, you can, in return for taking your time to watch this video today, you can send us an email at daytradinggps@gmail.com to request a special discount promo code that you can use towards your purchase of the indicator. You'll find the link to go to make the purchase of the indicator in the video description. And if you are interested in purchasing the indicator, all of our indicators are sold on a one payment for lifetime access basis, which means you make one payment and then you have lifetime access to the indicator. That lifetime access also gives you a any further updates to the indicator when we come out with new versions of it with feature enhancements. And we are planning on coming out with another updated version of this indicator that will be V 3.0 that will have several new enhancements and features to it. And that probably will be coming out in the next 3 to 4 weeks, somewhere in that range. At that time, the price of the indicator will go up substantially due to the new features being added. And so if you are interested in getting the indicator, if you get it now at the discount at the current price, and also adding in the discounted promo code, which you can request by emailing us, then you will also be entitled to receive both the 3.0 version when that comes out, as well as any other ones that come out in the future. Okay, also if you have an interest, before you purchase the indicator, in taking a look at our full features video, which shows all the inputs in the user control panel of the indicator, and also goes over each of the different features in more granular detail that you'd find in the user control panel. There's also some historical analysis features, as well as some other features that we did not go over today, as well as how to set up and use the indicator as well. You can also, when requesting the promo code, you can also request to see that features and setup video. That video is also sent to anyone who purchases the indicator automatically when they get their welcome letter. Okay, so now, as I mentioned earlier, we're going to go into the last part of this video, which is going to be approximately 25 minutes long, and it's going to go over how to take bullish and bearish entries off of the other main R1 through R6 and S1 through S6 levels that occur throughout, usually occur throughout either the mid-morning into the lunch or afternoon part of the session. So we'll be going over how to take bullish and bearish trades off of those levels, as well as the two types of trade entries, your standard entry, as well as the more conservative trade entry type, which takes a little bit more confirmation, and how to recognize that. Okay, so thank you for watching this part of the video. If you're going to stay to watch the rest of the video, thank you for your time today. And now we will be beginning the rest of the video. Thank you. Hello, in this video we're going to go over how to take trades off of the other main R and S levels. So this would be taking trades off other levels besides the bull bear key price level. So the main R and S levels are your R1 through R6 and S1 through S6. So if we zoom out here, we'll have R1 through R6, S1 through S6. The levels that show up as default on startup with this indicator are the PMH, PML, YDH, YDL, and YDC. So that's the pre-market SPX pre-market high, SPX pre-market low, SPX previous day RTH session high, SPX previous day RTH session low, and SPX previous day RTH session close. So the previous days are YDH, YDL, and YDC. So that's yesterday's high, yesterday's low, yesterday's close. PMH and PML are the current session's pre-market high and pre-market low. Pre-market high, pre-market low, YDH, YDC, and we move down. Here's the low from the previous RTH session. Also in startup, you will have R1 through R6, the bull bear key price level, and S1 through S6. You will also have QL above BBKPL, QL below BBKPL, the first midpoint above the BBKPL and the first midpoint level below the BBKPL. And this is because in 95% of the sessions or so, your trades at the beginning of the session, if you decide to take trades at the beginning of the session, are primarily going to be based on price action at the bull-bear key price level. However, there is no rule or obligation to take trades off the BBKPL. It is there for the session bias, to give you a bullish or bearish bias for the session, as well as the trades that you can take at the beginning of, like I said before, 90-95% or so of most sessions that you will see. However, you can just wait until price action bears out further on in the session and take trades off of the main R levels or S levels. As we've discussed in other videos, when you're taking a bullish trade off of the bull-bear key price level, your tight stop loss is the QL below the BBKPL on that bullish trade triggered from the BBKPL level, and your standard stop loss is the first midpoint below, which would be mid BBKPL S1 for a bullish trade taken off of the BBKPL level. Conversely, on a bearish trade taken from the BBKPL level, your tight stop loss is the QL above the BBKPL, and your standard stop loss for a bearish trade taken off of this BBKPL level is the first midpoint above the BBKPL, which is mid BBKPL R1. The same principles applies to taking trades off of the other levels. So if you're going to be taking trades off the other levels, then you simply need to turn on the quarter levels if you're going to be considering taking tight stop losses, or the midpoint levels for standard stop losses. So for example, if we're looking to possibly take bullish or bearish trades off of R1 or R2 or S1 or S2, then we would simply turn on the QL levels above and below those levels, as well as the midpoint levels. So you simply go into the user control panel, and first we'll turn on the midpoint levels. So we'll enable mid R1 R2, mid R2 R3, mid S1 S2, and mid S2 S3. And let's say we're also considering tight stop losses. Then enable QL below R1 and above S1, below R2 and above R2, and then the same thing for the S levels. Above S1, below S1, above S2, and below S2. Now you can leave it this way if every day that you want to consider taking trades off of this level. Just know if you reset the settings, it's going to go back to what I showed you before as the default. So for example, right now we're just showing R3 through S3. So for example, if price is coming down to S1 and bouncing off of S1, and you want to take a bullish trade off of S1, then your tight stop loss on a bullish trade is the first QL below S1, because S1 is the level that you're taking the trade off of. And the standard stop loss would be the first midpoint below S1, which would be mid S1, S2. So instead of a bounce off of here, if price came below here, then went back up and crossed above and closed above S1, and you wanted to take a bullish trade off of S1, it would be the same thing. You're taking a bullish trade off of S1, so your tight stop loss is the QL below S1, and your standard stop loss, if you choose that one instead, is the first midpoint below S1, mid S1, S2. Let's say the reverse happened. Price is slicing through S1 and closing below S1. And you want to take a bearish trade off of S1. Then on a bearish trade from S1, your tight stop loss is the QL above S1. And on a bearish trade on S1, your standard stop loss is the first midpoint above S1. So always just remember that on bearish trades from any level, your tight stop loss is going to be the first QL above that level, and your standard stop loss is going to be the first midpoint above that level for bearish trades taken from that level. And on bullish trades taken from any main level, your tight stop loss is going to be on bullish trades taken from the main level, your QL below that level, and your standard stop loss is going to be the first midpoint below that, whatever level that is. So on R1, if we were taking a trade of a breakout above R1 and we're taking a bullish trade, then our tight stop loss is the QL below R1, because that's the level we're taking the trade from. And our standard stop loss, if we choose that instead, is the mid BBKPL R1, because that's the first midpoint below the level we're taking the bullish trade from, R1. If we were taking a bullish trade on a breakout above R2, then our tight stop loss in that bullish trade on a breakout above R2 is QL below R2, and our standard stop loss on a breakout above R2 is going to be the first midpoint below R2, which is mid R1, R2. Now, in the reverse, let's say the price goes up to R2, now it starts closing below R2, and we're looking for a bearish trade off R2 to move down below to these levels below. On a bearish trade from R2, then our tight stop loss is the first QL above R2. If we choose instead to use a standard stop loss for our bearish trade taken off R2, then the standard stop loss is the first midpoint above R2, which is mid R2, R3. Same thing if we're taking a bearish trade off of R1. If we're looking for a bearish trade off of R1 or break below R1 or a touch and fall off of R1, then our tight stop loss on the trade taken from the R1 level is the QL above R1, and our standard stop loss on this bearish trade taken from R1 is the first midpoint above R1, mid R1, R2. Same thing applies to the S levels on bearish trades. If you're taking a bearish trade based on price action coming down, closing below S1, then your tight stop loss in that bearish trade taken from the S1 level is QL above S1, and your standard stop loss is the midpoint level, the first midpoint level above S1, which is this mid BBKPL S1. On a break below S2, then a bearish trade taken from S2 is the tight stop loss for that. On a bearish trade taken from S2 would be the first QL above S2 here, and your standard stop loss would be the first midpoint above S2, which is mid S1, S2. Same thing applies on S3 levels. If this was a bearish trade we were taking because price started closing below S3, so on a break below, close below S3, our tight stop loss would be the QL above S3, which we don't have because we didn't enable it on this chart, but it would be the first QL above S3, or if instead you're choosing to take the standard stop loss for your trade on a bearish trade from the S3 level. Then it's the first midpoint above S3, which is mid S2, S3. Same thing for a bullish trade above R3. Break above, close above R3, then your tight stop loss would be the first QL below R3, because we're taking a bullish trade looking for price to go up, continue going up. So you would enable QL below R3 if you want to use a tight stop loss. Keep in mind that if you're just using standard stop losses, then unless you have some reason why you want to see where the QL levels are, there's no reason to turn them on. So if you're just going to be using the standard stop losses, then you would just want to have your midpoint levels turned on, unless for some reason you also want to see, just for context, where the QL levels are. So again, in summary, if you're taking a bullish trade off of either the bull bear key price level or any main level, whether it's an R level or an S level, if it's a bullish trade, then your tight stop loss, if you choose to use that, is the first QL level below the level that you're taking the trade from, and your standard stop loss is the first midpoint level below the level you're taking the trade from. The opposite is what is on bearish trades. On bearish trades, then if you use a tight stop loss, then it's the first QL level above the level you're taking the trade from. If you're taking the bearish trade and want to use a standard stop loss level, then your standard stop loss level is the first midpoint above the level that you're taking the trade from, the bearish trade from. Bearish trade from R1, standard stop loss is mid R1, R2. Bearish trade off of R2, looking to go down, your standard stop loss is mid R2, R3. Bearish trade from the BBKPL, your standard stop loss is the mid BBKPL R1, because that's the first midpoint above it. A bearish trade taken from the S1 level, your standard stop loss is the first midpoint above S1. And again, on bullish trades, it's the opposite. It would be the first midpoint below. So if you're taking a bullish trade off of S2, first midpoint below S2 is your standard stop loss. Okay, so now we're going to take a look at examples of both standard and conservative entries, both on bullish entries and bearish entries. So first off, we're going to look at bullish entries. So here we have a cross above and close above. So we have a candle that the same candle is crossing above the level in question, in this case the bull bear KPL, but it would not matter what level it's on. So regardless of what level this is, you have a cross above and close above the level. That is your bullish entry on a cross above and close above the level in question. Your second option is take a more conservative bullish entry approach. And on the more conservative bullish entry approach, you are requiring a retest of the level, a successful retest of the level before entering your trade. So in the case of a bullish trade, you're waiting for a successful bullish retest of the level in question before entering your bullish trade. So on this more conservative option, the sequence is you have a cross above and close above the level, which we have here, followed by price falling back to test the same level successfully, meaning it's coming back down, it's not closing below the level, it's successfully retesting the level and closing above the level. So it's cross above, close above, fall back to retest on a bullish trade, close again above that level, that is your conservative bullish entry that requires a retest. Just keep in mind that if you are going to focus and use the more conservative bullish entry that requires a retest, that many times price, after initially crossing above and closing above, will just continue to keep closing above in successive candles, and there will be no retest. So just keep in mind that if you use the more conservative entry, there are going to be times where you are going to miss entries because there is not going to be a retest. In this case, there was a retest. So again, just to go over it again, the standard bullish entry is a cross above and close above the level in question, in this case the BBKPL. So you would enter on the close of this candle here. Or if taking the more conservative bullish entry approach, you're waiting for a successful retest for price to fall back to the level in question, but still close above the level in question, and that is your successful retest. So you would enter, you could have entered on this candle, or if you did not on those, you could have entered on this candle here, and it did retest the candle here. We had a retest here, but if you waited for this retest, you'd be paying a lot more. So usually the successful retest, you're just waiting for the initial successful retest. So this is the initial successful retest. This is the initial cross and close above. This is the initial retest. Okay, so just to take this one step further here, so as you can see here on the R1 level, we had a cross above and close above this level. So if you missed this entry here, or if you're just the kind of trader who you prefer taking trades off of other levels besides the bull bear key price level, then you have a cross above, close above here, and you would take that entry here, and you would base your entry on the R1 level. Now, just to clarify, the stop loss on either one of these entries here, down here, whether you took this standard bullish entry or the more conservative retest required bullish entry, your standard stop loss is the first midpoint level below the level in question you're taking the entry from. So in this case, on this sequence here, this is taken from the bull bear KPL, so your standard stop loss is the first midpoint level below the level in question, the bull bear KPL, so that is this level here. We don't happen to have the quarter levels on this particular chart, but if you instead wanted to use a tight stop loss level, then you would enable the QL below the bull bear key price level, and that would be your tight stop loss on this trade. And the QL is the midpoint between the midpoint and the main level. So on the new version, the 2.0 version, you have the auto plotting of the QL levels if you simply enable them. But here, as you can see, the tight stop loss would not have been hit either. But just keep in mind that on any entries, whether it's bullish entries or bearish entries, the tight stop loss is named a tight stop loss because it is tighter and there's more chance that it will be hit than the standard stop loss. So if you're going to use the tight stop loss, you're going to have less at risk because you're using the tighter stop loss. But conversely, the con side of that is that there's more chance of it getting hit. So you just have to be mindful of that. If you instead, like the second point we're getting at, if you waited to take an entry off of the R1 level on this cross and close above, then your standard stop loss on that trade is the first midpoint below the R1 level, which is this mid BBKPL R1. And if you instead took the tight stop loss, then it would be the QL below the R1 level, which would be the midpoint between this level and this level, which again, on the new V2.0 indicator, those auto plot as well, the QL levels. Okay, now we'll look at a bearish entry. Your standard bearish entry, you enter a bearish trade on a cross below and close below level. So here we have a cross below and close below the R2 level. So you would enter a bearish trade on this cross below and close below if you were looking to take a trade off of the R2 level and you were open to bearish trades off of that level. This would be your signal to take the bearish trade on a standard bearish entry. Your standard stop loss on this bearish entry is the first midpoint level above the level you're taking the bearish entry from. Since the bearish entry is from the R2 level, your standard stop loss is the first midpoint level above the mid R2, R3 level. And if you chose instead to use a tight stop loss level, then it would be the QL above R2, which in this case would be about right here. And again, on the new V2.0 indicator, it will auto plot that level for you if you go ahead and enable it. Now, looking at the more conservative bearish entry, it's just like the bullish one that we did, except in reverse. We're waiting for a successful retest of this level before entering the bearish trade. So in this sequence, it's basically the reverse of this sequence down here for the bullish entry. In this sequence, we have a cross below, close below candle. Then price rises back up to test the level in question and then closes below that level again. That's a successful retest of the level. So this is where you would enter on a successful retest. You could have also entered here. That would have been a little bit later, but that, either one of these candles here would be considered the successful retest. So even on the successful retest, since it's off of this level, it's the same stop loss. First, for a standard stop loss, the first midpoint level above, which is mid R2, R3, that's the first midpoint level above this R2 level. And if you chose to use a tight stop loss, it'd be the same as what we talked about with the standard entry. It would be the QL above R2. And the same thing would apply for any other level. So if this price action was happening down here on this S2 level instead of here on this BBKPL level, then it would be the same sequence. Cross above, close above, that's your standard entry. Cross above, close above, then retest and close back above, that's your conservative successful retest entry. And then your standard stop loss on an S2 level bullish entry is the first midpoint level below S2, which is mid S2, S3, and then your tight stop loss level on a bullish trade taken from the S2 level is your midpoint, the QL below S2. Okay, I hope this clarifies the entries and also taking entries from the different levels for you. Thank you.